Welcome to my live stream to talk about stocks. We had a down day in the stock market today. It is January 7th. It is Tuesday, and the NASDAQ was down substantially, down 1.89. And it started off the day trying to have a small gain, but then it just came down and it stayed down. Actually, sold off as we went throughout the afternoon of stock trading. So, what's interesting is yesterday we had a pretty strong rally. The NASDAQ at one point was almost up 2%. It ended more than 1% higher, but it really sold off today. So it was a down day. It was caused because some economic data came out. It really shows that there's plenty of job openings. Therefore, there's an expectation that there may be some inflation related to employment, as well as the fact that there's high interest rates and rates went up even higher, which is going to be downward pressure on growth stocks. So the NASDAQ really had a sell-off. The S&P as well had a substantial sell-off. And if you look at just for the 2025 year, the S&P is in the red. And the Dow also had a sell-off, and it is also in the red, almost 1% for 2025. So stocks are, giving up some of the big gains that we've had in 2024, 2023. So not a big deal. If we have a correction here in January, it's actually good news. Good news to see good companies see their stock prices go down a bit, and then an investor like myself can buy shares at a discount. I'm fine with that. So not sure how far it's going to rally down, if it's going to rally down further. But my best guess is that we're going to see more sell-offs, maybe continue tomorrow. And then we have Thursday off. The stock market is going to be closed to respect President Jimmy Carter. I think they're going to have a big ceremony in Washington, D.C., and the stock market will be closed. So the stock market had an interesting day. I think the economic data, and especially those interest rates, are really high. It's going to put some downward pressure on stocks. We had strong rallies in November, and I think we kind of took all the gains that were, expected. And now we're going to wait around for the earnings to come in, which will start happening in about 2 weeks, with usually banks coming out first and telling us how well they performed in the fourth quarter of 2024 and for the full year of 2024. So thanks so much for joining. It looks like we've got a number of people on. Soul, thank you for joining. Hello, I hope you're doing well. Hope you had an opportunity to invest in some stocks today at better prices. So just going along with just seeing where the market was at, looking at different sectors. When I look at, the biggest sell-off was in the big names within technology and semiconductors. NVIDIA had a huge sell-off, and that's with them announcing a lot of things at the Consumer Electronics Show, the CES show in Las Vegas. So they're really trying to pump up their ideas, and it didn't work. The stock really sold off 5.32%. Broadcom sold off. A few others in their space did quite well, like Qualcomm. I think this is Micron, and so forth. Within the larger, software infrastructure space, Microsoft was down about 0.91%. Apple was down. And those were the big players in that space. Within consumer discretionary, Amazon was down almost 2%. And Tesla was a big loser today, down minus 4.39%. The other sector that took a big hit was internet content and information within the communication services space. Meta was down 1.45%, and Google pretty much kind of held its value. Not too bad. Healthcare stood up tall, but the sector that did the best was energy. Some energy companies really rallied, like Chevron was up almost 2%, and Exxon was down up 1.3%. So a couple of sectors did okay. These tend to be good sectors in recessions. They tend to really hold their value well. And these technology stocks and these high flyers, they tend to really need lower interest rates. And the economic data is just showing that, hey, we're probably going to see inflation stick around, maybe become a problem again, which is going to be something that the government's going to have to deal with. We'll see how that goes. Looking a little further, just looking at the big names, the big name that probably did the best, I guess, is Eli Lilly, followed by Exxon. And everything else was pretty much red. Berkshire was up a little bit, but looks like NVIDIA really went down a lot. So that's one of the big caps, and that really brings down the indexes, which is good. NVIDIA's really had a great rise, and this is just giving up some of those gains that it had previously established. So not a big deal. I'm sure a long-term NVIDIA stockholder sitting on big gains, if we have some pullback in NVIDIA, it's not going to hurt that investor too much. All right, so that is my opening. Let me tell you about my community, and then we're going to get into analyzing some stocks. I have a community of investors. I started the YouTube channel a couple of years ago. And if you'd like to be a paid member of the community, you get certain perks. One of them being that you get to attend conference calls on weekends. You can nominate stocks for me to cover on these live streams. I've got a list of stocks that community members have put forward. I'll be covering that list. And you could be a member and do the same. Nominate stocks for the live streams, attend the conference calls on weekends, see the recordings on weekends, be on the Discord, and really see how I'm investing as well as other investors in the community are investing. So consider it. I'd really appreciate it. You can get more details in the details of the live stream, or you can go to my channel community page to get signed up. All right, so the first stock that I'm going to look at is Target. This was nominated as a stock to take a look at. And Target, I'm sure most people know, is a big retailer. My family, we tend to shop at Target. It has a good assortment of things to go buy for the family. And it's a very well-known company. It hasn't done so well for the past 12 months. It's actually down 1%. It does pay a attractive dividend at 3.2%. And analysts do believe that it's a little discounted, but the performance hasn't been good for 12 months. Over the 5-year, the performance has not been good. For, I would say, 4 years, it's really been a dog. But is it going to come back? Are they seeing growth? And do I think it's going to be more prosperous in the future? Well, let's look at their fundamentals and see how they're doing. First and foremost, we got to talk about revenue. Are they growing their revenue? Are more customers coming to Target and buying products? Once customers are there, are they buying, filling up their shopping baskets with more products? Now, for the trailing 12 months, just very modest growth, very light growth. When we go into the quarterly, last 2 quarters, they have small growth. They are a big company, but they're just barely growing. It's important for them to start growing. If they can grow 4, 5, 6%, it'll make a big difference. I think it'll really have a big impact on their overall profitability, a big impact on their cash flow generation, and their stock price will rally. Right now, it's just a slow grower. The good news is it is growing positively the last 2 quarters. When I look at their margins, this is a retailer, so it's not, overly impressive margins. Gross margins at 28%, which is a fair margin. They're retail. Not my favorite industry, by the way, but that's what they have. Free cash flow, $4.5 billion. Now they're a slow grower. Cash flow, $4.5 billion. The best in it, very well-known name. It's a very, very well-known name, very well-known business. I would say they're worth $75 to $90 billion. And I would say that's before I look at their debt. So looking at their market cap, it is priced quite attractively at $63 billion. I think there is some meat left on the bone, so to speak. I think there's some upside potential for Target. I think it's discounted by a certain amount. Let me check their balance sheet just to make sure they don't have too much debt. They have about $19.8 billion of debt, about $3.4 billion of cash. So about $16.4 billion of debt. Their EBITDA is $9 billion per year. So balance sheet's strong. They are a strong business. So this is a very safe stock. I think it's priced well. It's priced at a discount. I agree with this expectation that it's discounted by about 15% that analysts are putting out there. If an investor is looking for a dividend paying stock, that's a pretty safe stock. Target's a pretty good option. It's not something that I'm looking for. I'm looking for more growth and something that's going to accumulate wealth by increasing the stock price substantially. And this stock hasn't proven that over the last 5 years. And I'm not overly excited about retail businesses. So Target, I think, is a good stock for an income investor that wants a safe stock, a stock that one can understand quite easily. It's a retailer. You can go into a Target and buy products. I think their assortment is rather good. I find myself in a Target usually to buy things, and my wife shops there quite a bit. So Target is a good company. Stock seems reasonable. The next stock that was listed was Wendy's. And I haven't eaten at a Wendy's in a while. The stock is down 19% in the past year. They have a big dividend of 6.5%. And analysts are saying that it's discounted by 32%. Over the past year, it's really done nothing. It's down 30%. You get that dividend, but you're barely breaking even, which is not a good thing. If we invest in stocks, we're taking more risk than putting our money into a savings account, a CD, or better yet, buying a bond or a bond ETF. Those are presumed to be very low risk. Stocks are a higher risk, and we should get a higher return. And that's not the case when it comes to Wendy's. It's pretty much a losing stock over the last 5 years. Are they turning things around? Is the business looking better going forward? Well, let's take a look at some of their fundamentals. From a growth perspective, the growth looked good in 21 and 22. I think there was casual dining did quite well when everybody was cooped up at home due to COVID. But now Wendy's is not growing their business very quickly. In the trailing 12 months, the growth is only 1.6%. In the full year of 2023, revenue is only up 4.11%. So that is a problem. If you can't grow, that means that other competitors are probably doing far better than you are. I know in this space, Wendy's is kind of a more older restaurant. Maybe they're losing some of their appeal to the consumer, and they're not seeing as many customers, net new customers, become Wendy's clients. Their gross margin, 35%. I think that's reasonable for a restaurant. It's a retail business. Their free cash flow is not great. It's $280 million. The one thing I could say, it's been consistent, and it has had a more recent growth push. So that's been good. This business is probably worth about $3 billion less the net debt that's on the balance sheet. Let's take a look at that. They have $4.1 billion of debt, and they have $482 million of cash. So they have about $3.6 billion of net debt, which is interesting. Let's see what their market cap is. Yeah, I think this stock here is just not showing me enough. It carries more debt than it has as a market cap. And the cash flow supports a market cap of probably about 3 billion. But when you deduct debt, net debt from that, you get well below 3 billion. So this one here would be a hard pass for me just because there's not enough equity value in this company. If you look at all the shares that own the stock and then you add that debt, this business is just not very valuable. It's not a very desirable business. It's an older restaurant chain. It competes with McDonald's and all the others. The restaurants that are probably appreciating quicker, I know that Shake Shack's doing quite well. They've been opening new restaurants. The restaurant business, from what I've observed, is interesting. Younger restaurants tend to do well because they're a new thing. And I guess the consumer is interested in tasting something new, something they haven't tried. So they experience good growth. But after a certain time, it's an industry that's not desirable to me. It's restaurants. You have to hire a lot of people, rent out real estate that's usually expensive. The operations are expensive. Your margins are a little bit low. And you never create an incredibly valuable business. Even Shake Shack's 5-6 billion overall in market cap. So that's not a very, very big company. The biggest in the space, I believe, is McDonald's. That's above 200 billion. And that's a business that's been really successful for a long time. So this one here is a hard pass for me. There's just the fundamentals don't support the market cap. And maybe the stock market has realized that, hey, this is just not a highly desirable business. Not a lot of investors want to own it. So it's being sold off. So that is Wendy's. I haven't had a Wendy's meal in a long time. I know that way back when the last time I was there, I did enjoy it, but there's so many choices out there, so much competition for Wendy's to face that it's just a tough business. Another reason why I think it's an undesirable industry for me. I'd rather move to an industry that I think is more desirable, is going to command better margins, make more money, accumulate more cash, and create a more valuable business. All right. So thanks everybody for joining. We are at 11 people on the live stream. Thanks so much. I'll keep rolling along. Please tell me your comments on Target and Wendy's. Would love to hear what you think of those. What do you think about retail businesses? What do you think about restaurants? I'd really be interested in seeing what you have to say. Now, the stock that made a lot of noise today was NVIDIA. So let's take a look at NVIDIA and see what's going on with this very valuable semiconductor company. It was down 6% today. That's a pretty good drop. In the after hours, it's up a little bit, but that's a pretty good drop. In last 5 days, it's still up about 4% because it had a really nice rise. Several times over consecutive trading days, it went up, but it really came down today and gave up a good part of those gains. Now, NVIDIA does carry a pretty high PE for the current year of 55, forward PE of 35. This is where it gets really interesting is this company, shows that they are a cyclical business. They had good growth, but then they had no growth in 23. And then their data center business just exploded. They really just grew very fast. And the question will be, they announced late February, are they going to really show that they continue to grow? Well, let's take a look at what the forecast is and what analysts are saying. 40 analysts cover it, so plenty of opinions out there. And the opinions really vary from bears saying that the stock's really overpriced, that it's really only worth $87 a share. And you have some bulls who are saying, hey, the stock's going to continue to flourish and go up to about $220 per share. Well, let's take a look at the forecast. The consensus forecast for the company is that the business is going to grow, and their fiscal year ends January 28th, which is a little unusual, which means really the next full year is this year here. So their revenue is expected to continue to grow at 51.8%, which is excellent. But this is a really priced up stock. And when you look at the subsequent years of the stock growing much slower, if they miss on any of these and this forecast is a little too optimistic, this stock is going to drop quite a bit. Now, what's going to be the next catalyst to push the stock even higher? As we get into this year, really investors look at the next year in the future, which is going to be fiscal year 2027 for NVIDIA. And that's where they're going to face this 22% growth number, which is not a very it's a good growth number, but it's not overly exciting. That's the same number that Microsoft's doing. That's the same number that a lot of companies are doing. So would we see the stock price just kind of level off and go sideways? We might even see the stock price come down. If investors feel like, hey, I bought into an aggressive growth company, they no longer grow very aggressively. That's going to be super interesting to watch. This stock for the next 12 months is going to dictate a lot of things of where the market goes. If we have a big sell-off in 2025, one of the big stocks that's going to sell off is NVIDIA. And it's that important to the market. It was that important to the market in 24 and in 23. It just took off like a rocket ship. So NVIDIA, the forecast, 52% growth is excellent. So if they can exceed on that number, if they guided a little conservatively and keep beating that number, they're going to be fine. The stock's probably going to be trading upwards of $200 per share. But if they miss at any point, or their customers, which are Amazon with AWS, Microsoft with Azure, Google Cloud, if they begin to communicate that, hey, we're gonna stop spending so much money because we're not really seeing the AI business generate much revenue at all, that could be a problem for NVIDIA. And I think that could cause a substantial sell-off in the NVIDIA stock. We will see. The stock has flourished for some time. Over the 1 year, the stock is up 68%, 168%, excuse me. But just over the last 6 months, it's up 9.3%. So the last 6 months have been rather flat. Compared to the first half of 2024, it's been very flat. So investors, I think, are seeing that, hey, there's a ceiling to all this euphoria. There's a ceiling to how high NVIDIA is going to go up. And we'll see. Can they break through that ceiling, or is it going to come down? And I believe it's going to come down. I think the stock is overpriced. I believe the semiconductor industry is cyclical. And most definitely NVIDIA is enjoying a great couple of years with phenomenal growth. But I think businesses are going to pump the brakes on all this AI spending. It's just it's a lot of spend with not a lot of revenues, and profit is just non-existent. So we'll see. 2025, I think it's time for AI businesses to show that they're making money and not just show kind of a interesting use case. For example, ChatGPT was really, it just took off. Gemini is doing well for Google. Meta AI is doing great. But how much money is it making for those businesses? And is it really growing? Are users really using it consistently, long term? So that's what's going to be interesting to follow, and most definitely going to be one of the big stories of 2025. If we have a positive year in 2025, I expect NVIDIA did well. If we have a negative year in 2025 as a whole, I'm expecting NVIDIA really came down. So it'll be interesting to track it. And this stock today really made the index come down. Looks like Shadow Guy came in. Good to see you, Shadow Guy. So you really like Costco. You know, Costco is it's a business that has surprised me for many years. I kind of don't like retail businesses. But Costco, with their membership program and the way they sell in bulk, it has really been a successful stock for many, including Charlie Munger. This was one of his stocks. $409 billion market cap. For the past year, up 40%. For the past 5 years, up 215%. So really positive stock. And their brand is really valuable. I think you're right, Shadow Guy, because as I go, especially in Mexico, Costco is doing great. And I imagine in other countries, they would provide the same experience for shoppers, which is a very value-oriented experience for those shoppers. Now, I'm still not an investor because I just see this type of growth and I'm like, last couple of years, this is pretty typical. It's like a slow grower. I think a good grower, right? During COVID, everybody is buying, 20 packs of toilet paper, just really stocking up. They're a huge enterprise. I mean, look at that top line revenue. Incredible, really big. But you see their gross profit is pretty low. It's a retailer. So when we look at gross margin, it's 12.6%. That's what doesn't warm up to me a whole lot is, wow, that's not a lot of margin. And they do provide free cash flow, but not a lot of it. $5 billion on a very large revenue number. So I know that they're a really good business. I know they're really popular. Brand is great. So if I multiplied 5 billion times 30, giving them like the best valuation I can think of, it really adds up to about $150 billion of value, but they're way above that. So I've never understood Costco. Others have. And to this point, they've been right and I've been wrong. But I'll pick my lane. I'll make money in investments that make sense to me. And I encourage you to think about industries that make sense to you, that you really believe in, and try to repeat your success. If you find that you're good at particular types of industries, get good at them and make money. You don't have to make money in every industry. If an industry doesn't make sense to you, if you can't understand a business, don't invest in it. Invest in business that you really believe in and you feel like you can make good decisions on. And over time, you'll be really successful and make lots of money. For me, I try to stay out of retail. It doesn't make sense to me. I think that there's better businesses to own. And for example, I'm a big Amazon stockholder. I'm a stockholder in Alibaba, and I'm now a stockholder in Mercado Libre down in Latin America, because I believe the retail business is constantly losing to the e-tailing business, the online businesses. Those continue to grow much faster. They have more power. Consumers can shop 24/7 on their phones, on their computers. So rather than buying into retail, I buy into Amazon, Alibaba, and Mercado Libre. So, it's I appreciate you bringing up Costco, Shadow Guy. And again, the Costco investors have been right, and I've been wrong on this stock. And I know one investor in Costco is Scott's Due Diligence. He's done well with it. Good for him. And Charlie Munger did really well with Costco. He really liked that business. Looks like Mike, the dividend investor guy. So, looked at Wendy's. So you like cake. I like cake too, especially the glass of milk. But let's look at the Cheesecake Factory. Now, this is a kind of an older restaurant. It's up 27% in the last 5 years. But look at that 1 year, 51%. Beautiful. What's going on at the Cheesecake Factory? So they have, wow, look at this growth. Well, it's because they grew really fast because they contracted, and then they grew really nicely. But they continue to grow, which is good. The quarterly numbers show, 4% growth. That's good. When we look at their gross margins are better than what we saw for Wendy's. 41.79%. That looks good. Free cash flow isn't very high. $70 million. That is not very high. What's their market cap? Yeah, not liking their free cash flow. I think it's rather low. The dividend is 2.14. Analysts say it's overpriced a little by 5.51%. The past year, they've been on a really nice appreciation curve. And I'm not seeing the corresponding revenue growth. With that type of stock chart, I would expect they're growing at 10%, just something really exciting. I'm unaware of that. I've eaten at Cheesecake Factory, and it's not like I hear that, oh boy, people love that place. It's really red hot. It's actually a restaurant that's been around for a long time. And I think this stock here is a little overpriced. I have to agree with the analyst. 15 analysts cover the stock. The most pessimistic analyst is at $37 a share. The most optimistic analyst is at $59 a share. So on average, the stock is overpriced by 5.5%. They're expecting collectively that the business is going to grow. It's going to grow all right, 5% in 25, 6% in 26, and then almost 6% in 27. That's pretty good growth for a restaurant of their size. That's pretty good growth. And their margins are good. I just, playing with my cards open, I don't like restaurants. So, but for somebody that does like restaurants and understands them, this might be a nice little investment. I would probably want to wait for a pullback, especially if we're seeing stocks sell off. Maybe there'll be a pullback in Cheesecake Factory and there'd be a better acquisition price. But if there is some news that's very positive, if they're opening new restaurants, if the success of those new openings is really good, maybe there is a catalyst there to move the stock price higher. But for me, being a value investor based on fundamentals, and I don't like restaurants, I'd probably pass on the Cheesecake Factory. But good luck with that, Mike. And I think, Mike, you were a holder of Fubo. Congratulations on that. All right, so yeah, I can go with a cup of coffee or espresso with my cake as well. There we go. So you're going to wait for a nice pullback. That's smart. Get a better price and go from there. Yeah, so congratulations on Fubo. We had a guy yesterday, Carlos, that was also a Fubo stockholder. So that's great. It was up 249%. And did Fubo keep going up today? It did. It continued to go up 7.81%. So well, the last couple of days, that just really took off. It went from $1.43 up to $5.40. So congratulations. Awesome. All right, great. So everybody, thanks for joining. We're up to 11 attendees. I appreciate it. Rotel and Cheese, thanks for tuning in. Lardog, thanks for tuning in. So talk about Adobe. I could talk about Adobe, share with you what I'm thinking, seeing, why I continue to invest in that stock. Nectarts. Thoughts on Intel? All right, I can comment on that. Sasic, thanks for tuning in. Michael Anthony, good to see you again. And Michael Anthony, you made some predictions yesterday. I think you said, and you know what? I think on a couple of them, you're absolutely right. You were saying that certain stocks are going to go down like today, and look at the market sold off big time. So look at you. All right. So I think I covered Real Madrid. Thanks for tuning in. Appreciate it. All right. So let's keep rolling on a list of stocks here. We'll pick up on Adobe, which is something that I own. So Adobe is a really a really good software company. I like software companies. They really make sense to me, and I'm good with investing in software companies. And Adobe's one of a kind. They create products and softwares for the creative businesses, like people that are creating content for Facebook, advertisements online, and so forth. Over the 5 year, it hasn't really gotten the job done. It's only up 26% because it's had two severe pullbacks. Here's was a pullback of 2022, and then a more recent pullback with the scare that, you know what, AI is going to take uh, addressable market away from Adobe, that we're going to have AI bots creating content versus a human being using Adobe software to create content. Now, I'm not completely bought in on that storyline. I think that's overly optimistic that AI is going to do that much that fast. Maybe in 10 years. But between now and then, Adobe is showing that they continue to grow their business. They're growing their business at almost 11%. And it's a business that's highly profitable. Their gross margin rate is 89%. 89% gross margins. And they generate wonderful cash flow. So their cash flow, I'm not sure why it's not showing it for these years, but we're north of $7 billion and they keep growing at 11%. So when I value the stock, I see a nice discount in Adobe. And it's a stock that analysts think it is discounted by 37%. I agree that it's discounted. We have 26 analysts saying Adobe is a stock they're going to cover. The most bearish call out of 26 analysts is that the stock will rise to $445 a share. The most optimistic call is 660. So I am a believer that Adobe will rise. It's just a really good business. They have a moat where they have the best software for creative aspects of the digital economy, the online economy. And let's face it, we're just doing more and more online. So I think Adobe is going to be fine. It's good business. The market has sold it off. It's an opportunity. And I'm buying shares. I'm also buying shares in Microsoft as another software company. And I'm happy buying shares. I think it's discounted and misunderstood. So that is Adobe. Good company. They just announced here in December, so they won't announce until like March 11th or so. All right, so that is Adobe. So a couple other stocks that are really, really high priced. Let's get into AppLovin. AppLovin is a software company, very similar but different than Adobe. AppLovin they build a software platform for advertisers to enhance marketing and monetization of their content. So they are doing well. They're growing. Their growth really accelerated to 41%, which is impressive. They're a smaller company at 4.2 billion. And that growth has really excited investors to the point where the stock has really, really done well. Over the 1 year, it's really gone up. And to me, it's a little hard to believe that a stock could be, that priced up that much. But it's that growth that's exciting investors. Today, it came down about 7%. Over the last 5 days, it's still up almost 2%. This thing's been on a tear for a year. Over the last month, it's kind of given up some of its gains. But for the past year, it's just done great. You can see that the same company not too long ago was somewhat less appreciated. And then with that growth that they showed, it really just took off. One thing I forgot to check was their margins and their free cash flow. So their free cash flow, they are growing it very quickly, very good. And their free cash flow margin, gross margins are 73.89. That's very good. So this is a really good company, good business, really growing their business. It's interesting that they were growing very fast, somewhat hit a wall, stopped growing, started to get growing again, and now they're growing nicely. If they hit a wall again, this stock's going to really go down. Let's take a look at the growth forecast that analysts are stating for the company. They're expecting that revenue is going to grow at 41 or just grew 41% for 2024, but it's going to slow down a bit. Even at 20% growth, that's very good growth. So they could probably hold their stock price, but I don't see this stock going up much higher. They might even give up a good part of these gains that they've seen, maybe come down to $200 a share, or $150 a share. This one's just been a super winner in the marketplace. So AppLovin, one stock that's come up, looks like Andrew PC is in. Good to see you, man. So let me go over a stock that actually came out of the investor calls, live streams in our community that did really well today. It's a really, really bad day, right? Where the NASDAQ went down 2%. So Lantheus Holdings, which is a healthcare company, they are in the drug manufacturing for specialty and generic. And these guys, I believe they distribute their drugs for heart, cancer, and other diseases worldwide. And they assist in the ultrasound process. So you ingest their active ingredients or whatever compounds that are not going to be harmful to you, so that you can have better x-rays as you receive your healthcare treatments. And the stock's been working. For the past year, it's up 50%, but you can see this pullback. We started talking about it, once we started seeing this pullback. And I ran an evaluation on this, and it made sense. PE is really low, 16, forward P 15, strong buy according to analysts. When we look at their growth, they are a growing business, growing 24%, the trailing 12 months. The most recent quarter grew at 18%, 22, 23. So their growth is slowing, but part of it is that you keep getting bigger and your growth rate begins to get smaller because you're comparing to a larger number. So the growth looks really good. Pullback looked interesting that the share price has come down. The free cash flow looks very good. And then they have very good margins at 64%. They're in a generic pharma company, so they're not as profitable as, let's say, a Pfizer or somebody who. I still see that the stock's discounted by 35%. It's seen a nice recent rise. I know it went up today. I think it's seen a couple of green days in the year. So just in 2025, it's up 8%. Over the past month, it's up about 4.7%. But it gave me an opportunity to start buying into the stock and really start accumulating some shares. It's always tricky to buy into a stock that's working, but I'm going to keep buying it because, if it starts to work, I don't want to miss out on it. So it's provided good places to buy the stock, and I'm going to keep accumulating shares. Even on up days, I'm probably going to buy a few shares just to keep building up this position. I like the healthcare industry for 2025 because in 2024 and 2023, it didn't do so well. So it probably stands to do well because there's a lot of the fundamentals look far better than the fundamentals that we would find, let's say, in technology. When you look at PEs down at 16 and then forward PE for 2025 really at 15, that's really low PE for a growing business. It's profitable, generating cash. Analysts like the stock. I mean, a lot of things look good for the stock. And you find those in healthcare. Energies are working. So Healthcare is more consistent than energy. And I think healthcare is going to be a place where I'm going to buy more shares because I think that sector and the industries in the healthcare sector, it's going to do well in 2025. So that's a place where I am buying shares and I'm finding value in companies. Over the 5 year, this thing's been an absolute winner, up 400%. Total acquisition target for a larger pharma company or a larger business. Now that we have a president going into office that probably is going to just let mergers, acquisitions happen, this is totally an acquisition target that I expect could be acquired by a larger business. So that's Lantheus. Glad to see it's going well. This is a stock that's come out of live streams and weekend community calls that we've had. So good to see that stock's doing well. All right. So energy did not do well in 2024, but in 2025, it's off on the right foot. It's up. Chevron, as an example, is up 3% in 2025. And we're seeing oil prices creep up, which is going to help these energy companies. Now, today, this stock was up 1.58%. Looks good. This business is really tied to oil prices. If oil prices go up, Chevron's going to make a lot more money. If the latter, if oil prices come down, not so much. So it's good to see that Chevron had a good day and oil prices creep up. There's a couple of things that I'm seeing in the economy, right? You've got interest rates are high. The 10-year is fairly high. If you get a mortgage out there for a home, it's about 7%. You have higher fuel costs now with higher oil prices. So you're seeing those inflation factors really creep up. And I think that's going to have a little bit of stress on the economy. Those things are making me feel like we may see a down year in 2025. Just putting it out there, that wouldn't be surprised if we have a year where it's actually negative 10% for the year. It's good to keep some cash around so you can buy into stocks as they drop down, should it happen. I certainly have cash on the sidelines ready to go, and I'm buying into companies as they get sold off. But Chevron is one stock that is doing well in my portfolio. Probably own a little too much of it. So I've been actually selling shares on up days like today and just taking some of my position off the table and putting it in cash, getting ready for some type of pullback that could happen here in 2025 on other sectors like technology, communication services. And like I said, I'm buying into healthcare. So that is a good place to get some cash. But Chevron and Exxon did really well today. And I'm probably also, I think the smaller energy companies, because I know on live streams we talk about the smaller energy companies, they're probably doing really well too. So Enbridge, you've got Marathon Petroleum, you've got these smaller oil companies that are probably going to do quite well. So we'll see how things play out for energy, but I think it was the best performing sector of today. All right, guys. So that is going to be my stream. I wanted to cover the stocks that were put out there by community members, and would love for you to, everybody who's not a community member, love for you to sign up. Love to talk to you on weekends, and we can talk stocks. We can talk about how to become better investors, and you can sign up $10 a month, 25 or $100, depending on what perks you want. And please consider it. Would love to have you as a community member. And of course, you can nominate stocks. I'll take them and list them out for the live streams and make sure that I cover them. That way, if you are interested in a stock and you want one more opinion, you've got somewhere to take a stock symbol and get an opinion on it. So that is it for the evening. Everybody, enjoy your Tuesday night. And let's see what happens tomorrow. I'm expecting that stocks are going to continue to sell off, but we'll see. Maybe the market will reverse. It was interesting that we had such a up day yesterday and such a down day today. Net, we are down this week. So that tells me that there's some fear in the stock market. That big sell-off tells me the stock market is expensive, that people are looking to maybe cash out some of the positions they have. And that's definitely what I think is happening. But we'll see. This week, we're not going to trade on Thursday because it's going to be, the stock market's going to be closed. So we're going to trade tomorrow and we're going to trade on Friday. We'll see how the month of January comes out of the gate. It's going to set the table for 2025 and we'll see what happens. So everybody, thanks for tuning in. I appreciate it. Thanks for all the questions in the chat. And I hope you have a good evening. Take care.